Speaking of alternatives with Eric Adler, President and CEO of PGIM Private Alternatives. Affordable housing is essential to society, and while it has inherent challenges, those create opportunities for astute investors. Eric delves into the US affordable housing market with Soultana Reigle, Head of US Equity.
Accessible, affordable housing is one of the great societal challenges in the US, but also across the globe. The skills and expertise needed to identify locations and build quality, affordable housing are manifold. But for those possessing the capability, the affordable housing sector can provide attractive long-term investment returns while fulfilling a vital need for our communities and society writ large. Before we dive more deeply into the topic at hand, let's find out a little bit more about you, Soultana. Talk to me about how you came to asset management and more specifically the real estate sector. What interested you about it?
Thanks, Eric. I'm happy to be here with you today. I've spent my whole career in real estate, and I would say at the very beginning, what made me gravitate to commercial real estate is the tangible nature of the investment class. You really can touch and feel and tour the properties in the investments that you're ultimately underwriting, owning, and at some point disposing. I find it to be a very special industry. And a lot of that has to do with the people. It's a small industry. It's collegiate, very social. It's interesting work. It's challenging work, but ultimately it gets down to the great people throughout the industry.
That's interesting. A lot of people think of the transactional nature of real estate, which is true, but you've put it in another way, which is the social aspect. Relationships matter in all industries, but it's particularly strong in real estate. And I think everyone can identify with this tangible nature of what's ultimately a financial investment for a lot of people, but there's a lot of concrete, literally and figuratively to it. So affordability has become a ubiquitous challenge in housing. So we know about the challenges. What's your 1-minute elevator pitch on the opportunity?
Simply put, just that we have a demand-supply imbalance. That for real estate is the age-old, headline when you see an opportunity. On the demand side, we look at housing demand, having outstripped supply for the last 15 years. And you look at homeownership in particular, out of reach for many. And we have a huge demographic wave of people in the United States who are entering that phase of life. 35 to 44 years old. It's typically an age where you have a young family and you want that house with a little bit more space. And often that's in the suburbs. Right now, we have soaring home prices. We have high interest rates. And we really have in the single family space in the U.S. just a lack of mobility. There's just nothing on the market. Nobody wants to leave their very good mortgage rate behind and step into a very expensive mortgage rate. And so what that means is that the affordability gap between owning a home and renting a home is the widest it's ever been. And so because there's this immobility in the single family space, what that means is that the rental space becomes even more focused in terms of people looking for home ownership and living opportunities. So from that standpoint, as investors, we see a state of imbalance right now, but also growing over time. And that leads to an investment opportunity going forward.
Yeah, it's so tangible compared to other more esoteric opportunities. The trick is executing on it, which is anything but simple, but the challenge is really clear to understand. We also like to unpack a recent headline, and the one we want to explore today is the following. Housing remains America's biggest supply chain problem, which you've already mentioned. Should the Fed think more creatively about housing market inflation when considering rate rises? And secondly, is more public policy the answer?
I'm not a policy expert, and I can't even start to fathom or appreciate what the Fed has to take into consideration regarding interest rates. Until interest rates come down or there is some other factor that's supporting housing more broadly. And we're going to keep seeing this stalling within the single family space in terms of home ownership and really a disrupted real estate market more broadly. So we do need a fully functioning debt market. That's a huge contributor in terms of housing creation and housing preservation, particularly in the affordable space and for the normal transactions market, which we have not had in real estate for the last 18 months or so. Lenders in the space need to have capital returned to them so that they in turn can issue new loans. And a lot of that is a function of the fact that interest rates are high. There's stress in the system. People are not repaying their loans. There is a trickle effect throughout the industry that goes way beyond just costs of owning or renting a home coming down as a function of interest rates. So generally, we need a stable interest rate environment where there's some sense that rates are going to come down. We enjoyed really a below normal environment, but just something that comes down a little bit more from where we are today, I think is necessary.
The affordable housing market faces complex economic challenges on the local, national, and even international levels. Creative solutions, including public-private partnerships, can help to pave the way to success.
If we dig more into the detail, where would you say are the real areas of focus for you? And equally, where are the challenges in the space?
Our main focus when we think about housing in particular and affordable housing is really around housing creation. I mean, development. That for us is the real investment opportunity. You often see affordable housing units mixed with market rate units because a lot of jurisdictions have requirements around adding affordable housing to their resident base and having more opportunity for affordable housing within a particular city or county or even state. The opportunity for housing creation is supported by the fact that there are so many requirements or focus by cities, counties, and states to add affordable housing. And cities are getting creative around how to partner with private capital. So focusing on public-private partnerships, which can mean a city offering things like a low interest loan or some sort of tax incentive, a payment in lieu of taxes. There can be so many different creative ways to come up with a development budget that is going to work, but also it's a win for a city or a county who wants to add affordable housing, but can't do it alone. They're offering something, private capital is offering something, and together you're able to produce new housing units that are going to be very, very valuable. And at the end of the day, have a better than market financing opportunity on the back end through the Fannie Mae and Freddie Mac lending organizations, which are really mission driven. And so when you look at affordable housing lending opportunities, which is again, a big part of having a liquid, confident transactions market, we've got these two entities that provide a great source of liquidity within the space. And that's really important when we think about putting the entire package together on a housing creation strategy. And headwinds continue to be the broader capital markets, interest rate, and frozen lending environment. Fortunately, the fundamentals across the housing space are relatively good. So once we get a thaw in that capital markets environment, we do think housing generally should be poised for a very good few years ahead.
Good timing is vitally important, whether you're going fishing, telling a joke, or pursuing investment opportunities. Timing is especially important when investing in the housing market.
Thanks for that, Soultana. Now, we have distribution teams, sales teams with their ears to the ground with clients around the world. We ask them to gather questions from the floor, from the sales force, what they're hearing from clients. So let's go through a few of these. The first one is, and this is no secret in real estate, timing matters. So considering the challenging market backdrop, when is the right entry point for commercial real estate?
That's the $1 million question. What is that right entry point? Everybody wants to make an investment in a good vintage year, which is really, when you think about it, the trough of a cycle. When you think values have come down and should be on an uptick going forward, or at the very least, not continuing that value decline situation, which we've had in commercial real estate over the last 8 quarters or so. We're starting to see more confidence of investors either rescinding redemption requests or an uptick in meetings with investors wanting to get, reacclimated with the market or with specific strategies. And, whether they time their entry second half of this year or maybe first quarter of 2025. Not everyone, is looking to have the exact right timing, but I think, we're seeing some green shoots that indicate that the second half of 2024 seems to be where we're going to start to see some capital committing back into the space.
So second question, investors are clearly looking beyond the 4 food groups. And for those who aren't used to the real estate jargon, the traditional 4 asset classes in real estate are office, retail, industrial, and residential. Everyone knows we have to go beyond that. But what does that mean within housing, over and above this more traditional multifamily asset class?
When we look at housing now, as you said, it goes way beyond multifamily. And we love a strategy where we can have a lot of different types of housing, because you end up really diversifying across different income brackets, different age groups. It can become more of a demographic play as well, where you might be invested in senior housing, right? As we go into this age where the next 5 years, we see a real ramp up in the baby boomers entering those prime years in their 80s, when you start to see people make a move from traditional housing into a senior housing type facility. So there's a real opportunity in the senior housing space. We also think about things like student housing opportunities, particularly at large universities, large state associated universities, often public entities, but looking for housing at colleges throughout the U.S., where again, you're getting into a different age bracket, but very good credit as far as mom and dad are paying for, these student housing rents. And so again, there's a lot of stability and a very good income story in the student housing space. And it can also mean other non-traditional housing, at least for the institutional world, which is manufactured housing, which tends to be more of a ground lease situation where you own the land and the resident owns their home and they're just leasing their site from you as the landlord. So that has been a very fragmented asset class traditionally, but really over the last 6 to 7 years, you started to see more and more institutional investors understanding and really focused on, the positives of investing in the manufactured housing space. And then lastly, purpose-built single family rental. So again, we discussed earlier the opportunity within the single family space, given the headwinds on owning a home, but there are often single family homes that are purely rental. They have been built specifically as rental communities, and we look at them really as horizontal multifamily, if you will, because you're renting a house. It looks just like a regular single family home that you might own in a community. It's likely in the suburbs, and you get all the benefits of living in a home, but you are in fact renting. So you're not coming up with that very challenging down payment or locking into a mortgage rate that arguably is at historic highs. So we're seeing institutional investor interest across all of these asset classes and really preferring a housing strategy that's diversified in that way.
While housing is at the mercy of broad macroeconomic forces, local and regional factors and conditions can create attractive investment opportunities. Thoughtful and skilled analysis can help to reveal them.
Okay, well, a third question relates to the fact that a lot of what you're describing is kind of across the board. We both know that some of these dynamics are existing outside the U.S. as well, across European markets, some of the more developed Asian markets. But at the same time, you can't execute everywhere at the same time. So when you think across your mandate, across the U.S., what are some of the differences you're seeing in terms of strength of opportunity, ease of access, whether that's by region, by specific cities?
You have to pick your spots, and it is understanding those opportunities and which markets are more supportive or less supportive. Again, it gets back to this very fragmented nature of particularly affordable housing. You really have to be a local market expert, someone who's very tapped into what those opportunities may be, how they work. And I would say, interestingly, when you look at building in the Southeast market, markets, which traditionally have been much easier to build in. There's more land, there's more business-friendly environment, development-friendly environment. You might look at the Southeast, where you can actually build what we call naturally occurring affordable housing, which simply means that it's a lower cost to build, which means you can offer it at lower rents that automatically are affordable to people who make 80% or less of area median income for a particular part of a city or within a city in its entirety. So there are definitely opportunities in the Southeast in that regard. Interestingly, in the Southwest, the state of Texas recently had a very favorable program that offered a tax incentive, a very long-term tax rebate for owners who would build and keep their properties at 50% affordable for families making 80% of area median income or less. Just like the Southeast markets, it's often easier to do that just by the way that the costs to build are lower. And so when you think about programs that are very favorable to producing affordable housing, they're often happening in the states that you wouldn't think would be as focused specifically on affordable housing because they do have a cost advantage to begin with. So that's been a great surprise. And, we love being able to do business where there are these enhancements, again, where it's not a years-long process to put a capital stack together. In our bigger cities, in the gateway markets, it's a lot more challenging to put a housing program or project together. But having said that, we have also a great network of joint venture partners who, recognize what those programs are able to put together capital stacks that we can really pursue. And we have been successful in, Washington, D.C., in New York City, and Boston in finding those opportunities. And we continue to focus on other major markets as well. So it is a market by market, city by city exercise, but it's one where we're very focused on continuing to do that work because, again, it's a need. That need is not going to go away, anytime soon.
Well, Soultana, that's great. And it actually brought to mind a fourth question that did not come from the floor. It's coming from me. But we heard a lot about this migration during COVID, a lot of north to south. I think that the heat's come out of that migration. But to what extent have you been seeing reversal of some of that?
We're not seeing that same exodus, into these various growth markets from the north. I also think we're still early days in companies managing their hybrid workforce, right? And we're seeing some of the big tech companies out west mandating 3 days a week in the office. And if you moved away during COVID, well, you need to move back near a physical office. So we're starting to see some of that come in. And I think we'll see more of that pick up as, some of the growth around AI happens, particularly in our Western markets.
Soultana, thank you so much for bringing us your insights into this clearly complex but fascinating U.S. housing market.
Thanks, Eric. It was great being with you.
Okay, so now let me give you all my top 3 takeaways from this conversation with Soultana. The first one is interest rates, inflation, subsequent availability of financing have been major factors in the performance of most asset classes, but it is more complex and even somewhat paradoxical in the U.S. housing market. And Soultana described it well. This dramatic increase in the cost of home mortgage loans has materially slowed down the development and the single-family home transaction markets to the point that few first-time buyers can really get on the housing ladder. This has massively pushed more demand into the rental market and also made rental housing unaffordable for a historically high number of renters. Number 2, and it's following off of number 1, the structural lack of housing supply and inability to meet the needs of a growing and changing demographic has been pretty much an intractable issue for well over a decade, definitely since the global financial crisis. And the problem is worldwide. It's also across Europe. It's across the developed Asian markets. Now, given the general supply-demand dynamics we are used to in other areas of the business world, one would think that after all this time of a structural imbalance, that we would have made more progress in bridging this housing gap. So those are 2 challenges, but it really leads to my point number 3, which is the big opportunity, that although the challenges in building sufficient affordable housing are material, so are the opportunities for investment and continued collaboration between the public and private sector should bear more and more fruit in the years to come. This is a very attractive space for investors who can work with the most skilled and experienced managers in the housing space. Well, that's it for this episode. Join us next time when our guest is Jim Futh, Managing Director at PGIM Real Estate and a real specialist in digital infrastructure. He will be here to talk all things data centers on Speaking of Alternatives.
Speaking of Alternatives with Eric Adler, a podcast from PGIM. Follow, subscribe, and if you like what you hear, go ahead and give us a review. And be sure to look for the podcast, The Outthinking Investor, also from PGIM. This podcast is intended solely for professional investor use. Past performance is not a guarantee of future results. All investments involve risk, including the loss of capital. PGIM is not acting as your fiduciary. The contents are for informational purposes only, are based on information available when created, and are subject to change. It is not intended as investment, legal, or tax advice and does not consider our recipients' financial objectives. This podcast includes the views and opinions of the authors and may not reflect PGIM's views. PGIM and its related entities may make investment decisions that are inconsistent with the views expressed herein. This podcast should not be reproduced without PGIM's prior written consent. No liability is accepted for any direct, indirect, or consequential loss that may arise from any use of the information contained in or derived from this podcast. This material is not for distribution to any recipient located in any jurisdiction where such distribution is unlawful. PGIM is the global asset management business of Prudential Financial Incorporated, which is not affiliated in any manner with Prudential plc, incorporated in the United Kingdom, or with Prudential Assurance Company, a subsidiary of M&G plc, incorporated in the United Kingdom. Copyright 2024. The PGIM logo and the rock symbols are service marks of PGIM's parent and its related entities, registered in many jurisdictions worldwide.